Hello, hello, and welcome to the next edition of the CRE News Hour. It's a weekly podcast where we come to you live at 3 p.m. Eastern Standard Time to discuss current events and everything commercial real estate. My name is Henry Eisenstein, and I'm here with my co-host, Rafael Cayazo.
Good stuff, bro.
Did I get it? Did I get it?
Yeah, you got it. You got Koyasu. It's great, man.
Koyazo.
I appreciate it. And tuning in live from Arizona. I'm visiting my parents for Thanksgiving, but again, no rest for the weary, as they say. It's work, and I'm happy to do it. So
that's right. Well, that's right. And today's session, we're going to be talking about loan caps being decreased, retail leases, lease size falling, the remote work declining, and multifamily developers' confidence falling. A lot of things going down. And obviously a lot more today. So, Rafael, what do you want to start off with today?
let's start off with the first discussion topic, like you had mentioned, is the average lease size falls to new historic lows. This is a trend that I've been seeing in the retail space for quite some time. Historically, the retail footprint used to be a lot larger, with the advent of big box stores and retailers just taking a larger footprint. That was the way it was decades ago. But nowadays, the footprint continues to shrink, especially if you're operating in the quick service restaurant space. I work with several quick service restaurant concepts, and typically their footprints have dropped to sub 2,000 sometimes, or 2,500 square feet. So, but the benefit of a lot of these, smaller footprints is that the price per square foot that they're willing to pay is still very strong. In particular, if it's a great retail corridor. So that obviously is one where on the leasing side, you can still generate pretty sizable commissions because they want to be located in an area for a longer period of time. So you're typically talking about longer lease terms, and the price per square foot that they're paying per square foot is obviously higher as well. But this just talks a little bit about, some of even the larger big box stores like the Barnes and Nobles, and they reference Bed Bath and Beyond. And some of these other concepts have begun to shrink their footprint. More so just because, it is just streamlining of product and getting things moving within the store a lot more efficiently. And so that obviously this talks a lot about the statistics about the spaces that have been leased up and how they've shifted and whatever else. And so again, BizNow is one of my favorite publications where they offer a lot of great value on the commercial real estate news side. So, this was a very helpful article that kind of showcased some of the trends in the retail space. So I don't know if you've seen it on your end when you're representing sellers or when you're acquiring strip centers, but what are your thoughts on this?
Yeah, I think that it is fascinating how it's like we're going to have to continuously need to adjust with the way that we look at investment real estate, right? Where these huge, like I literally just was on the phone with a guy, okay, 80,000 or so square foot retail center, okay? And he just lost a Stop and Shop type of tenant, a huge grocery anchor kind of thing, who took up 65,000 of the 80,000, right? So, these huge businesses that are taking up a lot of space, right? These big box types of locations are definitely they're definitely being affected drastically, and they don't need as much space. So it's like when you're looking at these types of buildings, when we're looking at investment wise, it's like, I mean, obviously this is a huge opportunity for us, but it's like now you're going to have to come in and then basically chop up these huge locations to make sense of bringing on these smaller tenancies, right? And now you're going to have to start dealing with 30 tenants in a strip center versus maybe 12. It's changing the landscape in a lot of different directions, and it's also, I've seen this also where, a lot of people coming to us, the big types of investors are looking for grocery anchor types of retail centers. But I'm also seeing that a lot of them are also, there's a lot of vacancy in those types of centers where like these older grocery locations, like out in New Jersey, these are the common groceries are going out of business. So it's definitely changing the landscape of things about how I'm looking at real estate. And I think that retail's, you're going to have to continuously adjust as time goes on if you're a retail broker.
Yeah, 100%. And again, I think it just goes to show the evolution of property types over time. I'd imagine historically, if you look back even in the industrial sector, it was predominantly made up of a lot of manufacturing buildings, of a lot of, structures that were formulated so that you could produce a product. But with the advent of online retail, logistics has become a huge thing. So you start seeing a lot more companies taking massive footprints, you see these 1 million square foot warehouses popping up left and right in major metros across the country. And that's just a trend of, the demand in the marketplace. And so similar to
And
that
and,
trend, this is one of the
and
trends
even some
where,
of those,
huh?
are coming down. Some of those are coming down to
Oh yeah.
on square feet,
Well, it's
where they only.
unbelievable too. Yeah, we talked about it in previous episodes where you start seeing a lot more vacancy when you start getting up into the 250,000, 500,000 square foot, even up. I had a gentleman that came down for a regional conference for a commercial real estate regional conference here in Louisville, and they were talking about how they had a 1 million square footer, and they have there's 12 other available in the marketplace in Indianapolis, and they're just kind of like, man, we're sitting on payments to the bank for this building. We have tax payments, we have insurance payments, and so they're just bleeding, and they're just like, please come, someone come and take over this project. And so if you're a tenant of a 1 million square foot building, you can kind of name your price right now, in particular in that market. Maybe in other markets it's not the case, but at least in Indianapolis it seems to be the case.
Yeah, and also this is very interesting for I'd say like this. Let's break this down. On the broker side, I think that like you were saying that working with the types of working with great tenants, good credit tenants, people who have a lot of experience, people who have a lot of locations and are looking to expand, you're going to have a lot of opportunity right now to take advantage of a lot of these retail centers that are hurting. Same thing on the industrial side. You're going to be in a really good, powerful place where they're going to be taking on less footprint, which makes sense because you're becoming more efficient with your square footage. You don't need as much to make the same money, price per square foot wise, for the business. But like you said, I like how you brought that up, which is longer leases. People are going to start signing 10, 20-year leases on that. I think that's very, very common instead of the standard 3 to 5. Plus, also on the broker side, there's a lot of opportunity when it comes to leasing. On the sales side, I think there's going to be opportunity when it comes to all those vacant spaces, which you're going to start seeing more and more come up with the larger big boxes, calling up those owners. Because when you're driving around, guys, when you see the old Kohl's, the old Bed Bath and Beyonds, the old grocery anchor tenants, all this stuff that's going out, you're going to be able to jump in and call up that owner and say, hey, they're bleeding. You know this for a fact. And when you call them up and say, would you be totally against selling the property, they're going to be a little bit more open to it. Like this guy that I talked to, when I told you with the 65,000 vacant, he's losing $70,000 a month right now from his debt payment, which is $100,000, and he's bringing in $30,000 a month in net income. So burning cash, right? Crazy situation. And now on the business side, I think that there's the opportunity of listen, if you have friends or family or anybody who's trying to look for space, this is a time where you can take full advantage, not only on the broker side, but also on the business side, and get a really, really freaking good deal when it comes to retail and or industrial.
Yeah, no, I couldn't agree more. So, all right. So next up is we have one of Henry's articles. It's prominent analyst predicts commercial real estate stabilizes in 2024. MLB approves A's to Las Vegas, and multifamily builder confidence falls.
Yeah, so a lot here. Obviously, this is more it's a multifaceted article. But first and foremost, commercial real estate stabilizing in 2024. I think it's great news. I think that we talked about this last week and the week prior, that I think that commercial real estate is not going to see the crazy drop off that everybody assumed. That was number one. Number two, for those baseball fans out there, the Oakland A's are going to be moving to Las Vegas, which I think is super cool. They're actually going to be building out a huge, massive stadium out there, which is kind of exciting. So again, if you guys are huge into baseball, it's going to be exciting to see, not only the Raiders went out that way.
Yeah, the Raiders are there, and now they have the A's. I mean, it's unbelievable the growth Vegas has experienced, considering it's not Vegas is a big city, but it's not a massive city. So, yeah. I mean,
agreed.
They've been a beneficiary of a lot of growth over the last, decade or so.
And they just had the F1 there, right? So, I mean,
they have it. Yeah, it was this weekend, I think, right?
Yep. They just had it there. I mean, I heard there was a lot of crazy shit going on, but crazy experiences going on, but they had the F1 there. Yeah. So Vegas is blowing up. So again, if you're in the Vegas market as a broker or as an investor, I think it's a great place to be putting some cash. I mean, obviously that town is, it's seen some crazy times, both good and bad. I think it's kind of moving in the right direction, which is kind of amazing. And then obviously the last piece of this article, which is right on the screen here, which is multifamily builder confidence falls, which is just the fact that we're seeing right now a very, very interesting time in the development world, where there are some areas in the country where there is a massive lack of inventory. They need so much housing. And then there's some areas where you have such an overabundance of housing, it's causing major issues. And especially with the cost of debt today, where these huge home builders and apartment developers are trying to build in the areas that are in high demand, but it's so freaking expensive to build. It almost doesn't even make sense to build like it used to. So that's why they're seeing this massive, the confidence for these developers falling, which is kind of unfortunate. I wish they would give out more because you were seeing a lot of was it tax abatements? Yeah, tax abatements were very, very common to try to make sense of some of these deals. You get a 20 or 30-year tax abatement. It was at least giving you some wiggle room and some breathing room as a developer. But if you're not getting that, it's kind of hard to make sense of doing these deals.
Yeah, 100%. And, as you mentioned, I mean, I think and we'll get to another article too that kind of highlights this point is that there was a lot of exuberance in the market for multifamily as a property type over the last decade, really. Really since like, let's say mid 20 teens, so 2015 and
Yeah.
on, you started kind of seeing multifamily being one of the darlings of the commercial real estate space. I think there's a lot of people that got into the space that didn't necessarily have the experience, but again, they're just kind of riding the wave, and you start getting into a situation where you're kind of caught with your pants down when the tide goes out, as they say. But on the multifamily builder side, I mean, understanding how debt's structured when it comes to these development deals. I mean, you got a construction loan that's a non-permanent loan. Typically, it's an interest-only period. So for a period of time when you're starting to bring the product to market, your loan payments are obviously lower, and as you start to try to fill the project up, I mean, you can do all the projections you want as to say, okay, well, we fill this, we'll be at this point at 6 months, and this point at 12 months, this point at 18 months. And to maintain the competitiveness in the marketplace, a lot of these developers were trying to skew their numbers to say, okay, well, maybe we can get this done, in 12 months instead of 18 months. And, so again, you start getting into a situation where you're taking more and more risk. And, when we experience the largest delta jump in interest rates that we've seen in the history of this country, I mean, obviously, a lot of people got caught in the crosswinds, and so hopefully that changes. Like you said, Henry, I hope that developers start realizing that 2024 is going to be a much better year, and we start seeing a lot more people kind of take on projects in the coming year. So.
Yeah, again, I still think that it's up to the local politics, the local state, the local governments really making the decision to try to enhance the reasoning for these developers and saying like, hey, we're going to help you out here. We're going to give you a tax, a tax abatement. We're going to give you incentives. We're going to try to help you out where we can because they need housing. And without the right amount of people, I mean, think about it, like without the amount of people coming to town, spending money on local goods, like, I mean, these towns are going to have a lot of trouble in the long term. So, because the people are going to live somewhere, right? Like they're obviously, they're going to have to start moving out. They go geographically outwards, right? So like if there's not enough inventory locally, they're going to find a place to live somewhere not local. So I think the townships really need to be making better decisions and in supporting the local developers.
Yeah. And I think a lot of cities are trying to, in particular for some of the office inventory downtown, as we talked about in previous live streams. I mean, not all office buildings are going to be candidates for conversion, but for those that are, I think it behooves a lot of these cities to really push to try to get these buildings put back into circulation as far as valuable uses. So multifamily
Yeah.
obviously seems like the most logical approach. So hopefully we can see more and more of that in the
Sure.
coming years. But um, all right. So next up, we have where inexperienced multifamily investors rushed in, generational opportunities await. So again, kind of
I'm
leading back
excited.
to what we discussed in this previous article, there's been a lot of speculation in the multifamily market space. I think with the advent of social media and people becoming, YouTube influencers when it came to multifamily, you saw a lot of people that were starting syndications, buying up properties, promising, aggressive internal rates of returns based on, exit cap rates that were unrealistic, or not necessarily unrealistic. Maybe at the time they were realistic, but again, they were taking on a lot of risk because they assumed that everything would remain the same over a 5 to 10 year period. And as we know, commercial real estate and the real estate market in general is always in a state of flux. So you've got to be conservative when you're starting to look at some of these projects. And a lot of people that weren't doing that. And so obviously what they're starting to see is a lot more distress coming to market, a lot of debt coming due, and people just not being able to cover the delta between what they were paying before and what they're paying now. And so a lot of these institutional investors that still have a lot of cash, I mean, there's still a lot of cash in the marketplace. They're going to swoop in and they're going to buy up these properties. One of the news stories that was shared recently was related to this developer, or not necessarily a developer, a syndicator out of Houston who lost a 3,200 unit portfolio to the bank, Class B, which in reality was closer to Class C. They were targeting areas that were not the greatest, and they were trying to do a rapid overhaul of these types of projects, and they were using floating rate debt throughout the period of time that they were trying to stabilize the property, and it caused them to lose 3,200 units and all of their investors' money in those projects. And so, obviously that's one of the extreme cases, but even in scenarios where, you have people who were a little bit less conservative or more conservative, you can't account for such a big delta when it comes to the interest rate spike. And if you don't have the pockets deep enough to weather the storm, you could find yourself in a situation where you have to, go to foreclosure sale. So
100%.
that's kind of what they're sharing here. They've interviewed a couple bigger investors and REITs regarding some of the opportunities in the marketplace. We talked about Trepwire or Trep, which is a big CMBS data aggregator that kind of shared some insights in the article as well. So super insightful. Kind of echoing a lot of the discussion we've had on previous episodes as well. But I wanted to get your take on the discussion.
Sure. Yeah, I think that this is something that over the next coming years is going to be a bigger and bigger opportunity, right? Like multifamily is still a super hot asset class. I mean, not only has it been a darling since the 20 teens or even slightly earlier, it's blown up drastically. Where I still think this is like the predominant asset class to be targeting these days, right? Where I think that there's just so much opportunity in the multifamily space, where if you can come across some good opportunities in the multifamily space and some good locations, you're gonna do unbelievably well, right? The upside in multifamily, I think, is huge, and obviously this is an opportune time where if you're a cold caller like me, if you know how to prospect and pull lead lists, I think you're going to be able to target some great properties to call up right now. I literally just made an offer on a building, over 100-unit building in Jersey. Similar situation, very, very similar situation. They bought it for a long time ago. They have some debt issues. I think there's going to be a huge opportunity for us to come in and buy the property at a great price, because they're going to be losing the property anyways. For one reason or in the fact that they're just breaking even, right? Their floating debt is causing the major issues right now. So it's like you're going to be able to come in and find these opportunities where you're going to be able to make a pretty awesome broker fee, or take down a deal yourself and syndicate a property that is going to cash flow in the future at a high rate. So I think that this is a good way where if you're interested in getting into the space of commercial, let this be a huge flag to say hey, this is the time. Pick up the phone. Start targeting some people who have some floating debt. Listen, you can literally go in Reonomy and you can target properties that have debt coming due. In CoStar, you can literally target properties that have debt coming due. You can simply do this and find properties that have the phone numbers right there. This is not a complicated thing. You can go in the description in my videos, download a script. You say exactly what I say, and you will get results. So I think this is a huge opportune time to make some money.
Absolutely, for sure. No, I couldn't agree more. And again, in any market, regardless of whether it's great or whether it's bad, there's always going to be opportunity for those who are willing to put their nose to the grindstone and make it happen. So in the meantime, guys, we have plenty of people watching on all the different platforms that we distribute on. Please engage with the conversation. We'd love to hear what your guys' feedback are. And then also, if you guys have any deals or any opportunities that you guys are interested in sharing with us, we'd be happy to help you analyze and kind of look through some of those opportunities. Feel free to reach out to us at deals@crenewshour.com. That is deals@crenewshour.com. So we'll go ahead and share the next article. Henry, do you have anything you'd like to add?
Yeah. Again, if you guys are watching live, make sure you drop some of your not only opinions of the articles that we're reviewing, but if you have any questions about any maybe articles that you've been reading, or questions that you have in regards to the nature of the economy right now, the state of the economy, please drop in the chat. We'd love to be able to support you, and also let us know where you're tuning in from. We appreciate that. We'd love to know where our viewers are tuning in from. By the way, this is the new article here. Remote online workership to hybrid in some major U.S. cities. This is talking about the fact that in a lot of major U.S. cities, we're actually seeing more people come back to work than they are actually going to the hybrid model. So I think this is super interesting to notice and pay attention to. Like, hey, like the Class A office in some areas is still doing okay. You know, there's a lot of there's some Class A office that's still doing well, and there's some areas where like they're just seeing a much bigger tail off, which you can see. I think Washington D.C. was the big one.
Hmm.
Where they're actually seeing a drastic increase. Not drastic increase, but they're still seeing an increase. I think it's almost 10% actually, a
Yeah.
10% increase year over year of people not going to the office versus most of the other ones. You're seeing a 5 to 10% decrease in people working from home. So very, very interesting. You know, when it comes to the office space, I think this is good news for the office brokers out there. But let's get your take on it, Raphael.
Yeah, I agree with you. I mean, I've talked to several office brokers around the country, and it seems to me that that's improving. Obviously, it's a slow improvement. It's not quite what we'd expect, pre 2019, but again, there is value in being in the office space. There is value in engaging with your team. There's value in engaging on a day-to-day to build culture, which again, I don't think it's very hard to build a culture when you're not physically around people on a day-to-day. And so, I kind of echo that same sentiment that a lot of these office brokers are echoing, which is great. It's fair. It's that, if you want to build a strong culture, if you have a lot of younger professionals that are joining your organization and you want to, teach them how to operate within the organization, there's no better way than to physically be there. And whether that means you take a little bit smaller of a footprint, I still think that you need to have some form of physical presence in a building to be able to make sure that you're able to, maintain a strong culture for your organization. So,
Yeah, just like the retail though, they're seeing major drop off in size and square footage of the leases. I
yeah.
think that overall, just like every type of asset class is seeing the same, where like people just don't need as much space as they once did in order to have the same type of results. So super interesting to keep seeing this across the board. So taking major notes that like, hey, not that you should get into like the WeWork idea, of really going super small. However, the smaller sized office, smaller sized retail spaces, smaller sized industrial leases are very, very they're very lucrative right now. And I think that being able to capitalize on those types of buildings where instead of buying a huge, several 100,000 square foot industrial building, obviously if it was the right price per square foot, you always buy the deal. But you realize that you're going to get into it and then you're going to chop it up into smaller pieces and try to make some money that way. So just food for thought of like making sure like you're targeting the right type of product and knowing what you're going to do with it to make the most money possible.
Absolutely, couldn't agree more. And just wanted to give a shout out to those who are listening. So Cyber Relay is tuning in from Los Angeles. Great to hear from you, man. He did also ask, what's the most affordable way to access Reonomy? I'm sure you can comment on that, Henry.
Yeah, so I'm actually funny enough. I'm actually working with some of the VPs of the company now to try to figure out an affiliate way to get savings out to our audiences. So we're trying to do that, but right now it's about $400 a month if anybody's going to get it, on your own. But I'm working on trying to figure out some ways that we can save you, somewhere between 5 and 20%, depending on what they're willing to give me. But we're negotiating. I'm trying to negotiate a good deal for you guys, just like I negotiate for real estate. But besides that, I'd say join a brokerage that has it already. There's some
Mhm.
brokerages that already have it. You can save some money that way too.
Absolutely, yeah. And there's other software systems out there that are great as well. And but again, commercial real estate software is expensive. Reonomy is pretty relatively expensive. I know CoStar is probably the most expensive. So if you guys have the opportunity to join a brokerage that does have it already, obviously that can really be beneficial to you all as well. So. All right. So this next article is one that I had, and that's the Fed gave no indication of possible rate cuts at last meeting, minutes show. So again, this is kind of similar to what we've been discussing in the past, is that, again, the Fed is going to keep all their, information and their what they plan to do somewhat close to the vest. They want to be able to control, the narrative when it comes to where interest rates are going to be going. Obviously, there's a lot of people out there speculating where they could be going. But, this is what I envisioned the Fed to do to begin with, is that they're going to hold steady for a while. They're not going to raise the federal funds target rate again, because they realize that inflation is starting to come down. If you look at month over month, there has been a sizable decrease in the core inflation rate when it comes to, the variety of different goods and services that they track in the economy. So the restrictive policies that they followed are currently working. So, in my estimation, and again, this has not been something that the Fed has said, but I do believe that there will be rate cuts at some point, probably in 2024. I think it will likely be near the end of the year. There's some analysts saying that it could very well come sometime in the first or second quarter of 24. I still think that's a little bit aggressive. But again, this is all speculation. We're all just kind of shooting in the wind when it comes to this sort of thing. But you can kind of see, I mean, there's been a sizable response by the market as a whole regarding the 10-year treasury. You know, as you guys know, the way that a lot of banks, determine what type of interest rate they're going to be charging is usually on some form of index like LIBOR, sometimes a 10-year treasury. So, it's kind of a somewhat good indication if the 10-year treasury starts to dip off a little bit, you can start seeing some stabilization in interest rates being charged by banks, and the delta between what they're being able to hold the money at versus what they're offering as an interest rate begins to shrink. Therefore, interest rates will begin to dip off a little bit. And you've already kind of seen it a little bit. Lenders were hovering in that 8% range. Now they're starting to dip off a little bit more, kind of into that 7 and change range, at least based on the lenders that I've been talking to. So not sure if you're seeing the same thing on your end, Henry, but I'd love to get your take.
Yeah. I think that, and even some smaller local banks, depending on how much money you got with them, are even starting to touch sixes. Obviously, if you have 750 plus credit scores or 800 plus credit scores and have $500,000 to $1 million plus with the local bank, they're really going to get flexible with you. But for the most part, you're definitely still in the sevens. I just think that, what's really fascinating here is that if we really take a moment to look at this, we're in a place where we're in a transitional phase when it comes to the interest rates. We're finally at a top. What I feel like finally, I do believe this is a top when it comes to interest rates. I don't think we're really going to see much more increases, and if we do, it's a quarter point there. But really, just to really finalize this curve to inflation altogether. And I think, like you were mentioning, in 2024, sometime between mid and late 2024, we're probably going to start seeing. Hopefully, we should start seeing, at least from what we're seeing from economists today, starting to see a tail towards getting a final decrease or starting the decreases when it comes to interest rates. But it's been cool. I mean, look, if you see down below, we actually get this from ComLoan. If you're wondering where we get this data, we get this from ComLoan. This is updated every single day, pretty much almost by the minute. Actually, pretty an amazing software. So you get to see the rates as they change on ComLoan.com. You can check that out. But basically, these are the majority of the interest rates that you'll see on there. We try to update that each and every single week, so you can see that this is up to date as of today. And you're starting to see it in the sixes. I mean, this is amazing. I really do think that in the next 6 to 12 months, we're going to hopefully start seeing more rates in the sixes, especially for commercial real estate loans, depending on how much money you're putting down, credit score, and other things. We actually might start seeing some pretty good interest rates.
Yeah. And the difference that you can experience from an 8% versus a 6% is sizable. I mean, it makes a lot more deals pencil, which is what we're having trouble with right now. That's why the investment real estate market has dropped by like 70% year over year, because you go from a 4% all the way to an 8%, and all of a sudden a lot of these deals just don't make any sense anymore. And so, I think with the easing of interest rates coming into 24, you're going to start seeing a lot more velocity of deal, which again bodes 100%. Well for everyone. I think we all do well when there's movement in the market. So I think there will be a lot more movement come 2024.
Yeah. And again, if you guys are tuning in live, make sure you guys drop your questions in the section down below. In about 10 to 15 minutes, we're going to be doing some Q&A. So if you guys have any questions, make sure you drop it in the comment section down below. We'd love to be able to support you. And again, we do this every single week, Wednesdays at 3 p.m. Eastern Standard Time. We'd love to try to, build up the audience. If you guys like this type of content, please give this a thumbs up on any platform that you're checking it out on, and share it out with your audiences. We appreciate it very, very much.
Absolutely. So next up is one of Henry's articles: gap in new U.S. apartment supply and demand expected to narrow in 2024.
Yeah, so we mentioned this a little bit in regards to the beginning, which is we're at look at that right there, 40-year record high. 558 units or 558,000 units are expected to be added to the market this year across the country, while next year a projected 440,000 units will come online. So the supply of new multifamily units has been outpacing demand for the past 8 quarters, pushing the national vacancy rate up. Obviously, according to CoStar data. So this is actually super interesting. If you start to continue, really combing through this article, this is showing you that, there is an oversupply, like we were mentioning, an oversupply in a lot of different areas, but in some areas, like, obviously it's going to go through some different parts of this. Like there's some parts in New Jersey where there's an unbelievable oversupply. There's some parts in Miami, Florida, a drastic oversupply. There's some areas in a lot of these major metros, the Dallas Fort Worth area, where there's a drastic oversupply of apartments available, which is causing it it's very, very difficult. You can't make money. You can't make money when there's that much of an oversupply, and you have all these buildings that were for quite some time at 90+% occupancy, where now you're starting to see 70%, 80% occupancy. I mean, that's going to kill deals.
100%. And what people often fail to understand too is, there's people out there that I heard this all the time, is that, we target, B2C buildings and B areas, and our idea is to come in, take the property, fix it up and make it look really nice so that people want to live there and the rents go up and everything else. But what people also fail to understand is that if there's developers out there that are building brand new product, like literally new to market, the best amenities, you can Class A type of product, and they're having issues filling their space, what do you think they're going to do in order to make sure they can actually fill it? They're going to start lowering their rents, offering concessions. So those individuals who bought the B class multifamily or whatever, even if they make it nicer and fix it up or whatever else, it's very hard for you to compete with a Class A product like that, because, why would I live in one place for the same amount of rent I could live in a brand new Class A building? So you start getting in a situation where you start losing those battles to some of the newer developers. And so, again, you're not immune to it. If there's oversupply, regardless of where you're at in the cycle, in the hierarchy, you're not going to win. There's going to be situations where there's going to be some disruption. And so, I think just thought I'd share that comment.
No, sure. I mean, look, it's something that we look at. It was one of my close friends and investors that I do a lot of business with. He's very heavily in the self-storage market. And one of the first things that we look at, we go, what is the local market rates and what kind of competition do we have in that market? So it's like, hey, there's been 2 brand new facilities that in the last 20 months, and much as quote rental rates are quote, high, or maybe they're not, it's like you got too much competition in that area, brand new competition, right? It's not going to be smart to buy another piece of property in that area and try to put up some where the demand might not be crazy high. However, if you're seeing this in any asset class, multifamily for a moment, if you're looking at multifamily and you say like, hey, these are in some crazy suburban areas, where like, oh, I could buy 40 units at a pretty good price per unit. It might not be super worth it if hypothetically the rents are only going to be X price, right? Because there's not going to be enough demand in that local area to even make it worth it. So like you have to be looking at the fundamentals of like, okay, hey, I might be wanting to buy multifamily, but just because there's 40 units available in X area, is there the level of demand where I can actually take these rents to, grow? If I can increase these rents over time, where I'm actually able to make some good money on this deal, right? If your IRR, these types of investment, 10% or 10 or 15 maybe percent, it'd be really hard to raise capital on those deals if you're projecting at most maybe 10 or 15%. Right. I mean, now we're looking at IRRs for all the deals that we're doing right now between 25 and 35% IRRs to make sure that we can make sense of doing these deals. Because if that's projections, we're probably going to be closer to 20%, or 80% of that number, right? So if we're projecting 25s, we're going to be hitting 20s. If we're projecting 35s, we're going to be 25s. So it's just, we need to be paying attention to like, hey, not every single deal is penciling, especially where you're not going to have the type of demand that you need.
100%. No, I couldn't agree more. So next up is we have an article that I have regarding home builders. So home builders sense better times ahead. So as this is kind of survey data and also just economic data pertaining to where more mortgage rates are. So obviously with home builders, mortgage or home demand is driven heavily by mortgage rates, and so as mortgage rates begin to tick down, the buyer pool begins to increase, and obviously the sentiment for builders to want to build new product also increases as well. And so that's what we're starting to see slowly in the marketplace. Surprisingly, even in our local market, I'm sure you can comment on Miami, but historically, especially during 21, 22, our inventory was crushed. I mean, we only had, I think, like 1,000 homes on the market at one point, which is, the pre-pandemic, the average homes on market was closer to 4,000 homes. So it was literally at 25% of what the average, the historical average was for the Louisville metro area. And nowadays, even with interest rates as high as they are, there's only like 2,000 or 2,500 homes on the market at any one given time. So there's still a limited amount of inventory in the marketplace. And as a result, pricing really hasn't dropped off too much, at least in our local market. So even from a builder's perspective, if you were to decide to take down a project right now, you would still have somewhat of a delta between the shortfall, which I think could potentially bode well for, home builders in the area. And as interest rates begin to tick down, the demand, the buyer pool is naturally going to start expanding. And so, I'm sure this is going to be a trend for home builders across the nation. Obviously the markets that have been hit the most hard by these types of higher interest rates or markets where homes are expensive. If you were to try to buy $1 million property at a 4% interest rate, you're not going to be able to afford nearly the amount of the amount that you need to at 7%. Whereas, in the Midwest, kind of where we're located, the average home price is in that 250 to 300,000 range. I mean, a slight delta in interest rates obviously is going to affect the affordability, but there's still a lot more people available that can actually afford those types of properties. So, obviously it's market specific, but, I thought this would be kind of a helpful article for us to discuss a little bit about what the future of home building looks like in the U.S.
Yeah, right now I was actually just trying to log into my MLS in Jersey, the residential MLS here. Right, back in February and March in my mom, I grew up in Monmouth Ocean County in Jersey. There's a Monmouth Ocean County MLS. There was 1.7 months of inventory back in March, which is crazy. I mean, like similar to you. I mean, it was definitely like 5 to 6 months worth of inventory. Right now, we're hovering at about 2.23 months worth of inventory as of October, which is freaking unbelievable to even think about. The average days on market, we're hovering at around 33 and a half days on market. We're looking at around 99.3% list to sales price ratio. When back in June and July, we were well over 100% again. Was unheard of. In most of these markets, it's crazy that it's still going like that. We're starting to see, let's see, new active listings, new listings that are on the market right now. Let's see. We're looking at 3,300 active listings and 1,500 sold listings a month, when those numbers were triple a couple of years ago. And the average sales price is now at $642,000 average. Before COVID, it was under 400.
It's crazy.
It was like 380 before COVID, and now we're at 642. So I mean, I don't know what that is, like 60% increase. It's just freaking unbelievable to think about these types of numbers. But crazy. If you're in the market right now for buying a house, I think that what's going to be interesting though is that once interest rates drop, housing prices are going to keep going up. Right? It's not like there's not going to be this point of like housing prices dropping off. So like, I think that you find a good deal, or as good of a deal as you can, buy now, right? If I'm not a belief of Grant Cardone talked about never buying a house. I think that's kind of stupid. I think that you should buy a house, but it should not be because you're looking to, make a ton of money on your house. However, if you're looking for the perfect time to buy, this might be it.
Well, I don't think there's ever a perfect time to buy. I think just getting in the game. I mean, anytime that you're talking about real estate, it tends to appreciate over time. If you do your research and you pick the right locations and whatever else, you can kind of mitigate some of the risks by, that sort of thing. Like I bought a fourplex here in Louisville back in 2018. And at the time, I thought it was somewhat quote unquote not necessarily overpriced, but it was near the top of what I think the value would have been in 2018. So, but I bit the bullet. I bought it and I lived in the unit for 2 years and rented out the other 3. And then I still own it to this day. And it's worth double what I paid for it in 2018. So I'm sure someone would probably look at it today and say, oh, well, that's overpriced. But it's like, okay, we'll wait another 5 years and see what it's going to be, what it's going to be priced at. So it's one of those things where, it's all relative. So I'm of the mindset, if you're going to get in the game, get in the game. And over time you'll start seeing the fruits of your labor pay off. And not necessarily fruits of your labor, but you kind of see the natural increase of real estate pricing over time.
There's the old adage about real estate, which is don't wait to buy real estate, buy real estate and wait.
Yeah.
Right. It is the wealth game of real estate is by being patient. And if you're, it's not a get rich quick, it's a get rich for sure game, right? The longer you hold it, the longer, the more of a guarantee you are going to have made money in the business. So anyways, I appreciate you having that article, because I really think that it's important for people to be paying attention to. Like, in the I think it's like a break even of like 10 or 11 years right now, because of how high interest rates are between renting and buying a house. However, if you're going to be in an area for 15, 20-ish years, you're going to be in a decent place to really make some great returns on investment. And I think that if you're, especially if you can buy a good property, like I'm a huge fan of off market deals. Like, I don't just wait for properties to be listed on the market. If you want to find, a good opportunity, find the most piece of crap property you possibly can in a great location, call it up, and don't stop calling until they take your calls. That's our philosophy. But I would call the best neighborhoods and try to find the most beat up house in that area, renovate it a little bit, so I know that day one I'm already making money, and I'm not trying to go through some crazy bidding war. And sit on it, own it, live in it, enjoy your life. And I guarantee you're probably going to see some decent appreciation over the next 5-10 years as interest rates start to fall.
Yeah, 100%. And with residential real estate too, you can have multiple loans on your personal name before you have to actually go and get commercial financing. I know people who own like 7 or 8 properties, and they just bought one property, lived in it for a little while, rented it out. Then buy one property, lived in it for a little while, rented it out. So there's a lot of flexibility with residential real estate. And
I think that's super smart. I think like one of the first multifamilies I ever bought was a 4-family. Did the same thing as you did. I did an FHA loan. I bought it, lived in one unit, lived there actually for 2 years, and then I just got offered a stupid price, so I sold it. But it's tax-free money, right? Because you lived there for 2 years. It was my primary residence. I didn't have to pay any tax on the money. So I think it's important for people to pay attention to, like, especially if you have not bought a piece of real estate yet. If you buy a 4-family property, live in one of the units, it's going to be one of the best investments you ever make.
100%. Yeah. On the IRR standpoint, it's one of the best you can possibly make. So, all right. So last article before we open up to Q&A. So Fannie, Freddie face lower cap on apartment loans. Bank of America offers brighter outlook. High interest rate hotel loan heads to market.
Yeah. So I wanted to talk about this, which is just interesting, where it's just like, in the capital markets, there is less money going to be allocated to certain types of loans that are going out there, right? So specifically multifamily, which is like what we were talking about earlier on before. We were talking about how, right now, Fannie Freddie lower cap on apartment loans. The Federal Housing Finance Agency has lowered the amount of multifamily loan purchases Fannie and Freddie Mac can complete by 2024 by $10 billion or $5 billion a piece, which means that, we're dropping the $75 billion cap for each government-sponsored housing lender, now reduced down to $70 billion each. These under new guidelines, half of the loans will have to be targeted at affordable housing, which is also incredibly interesting. And the 2 mortgage giants have securitized nearly $80 billion worth of multifamily loans this year alone. So this is just interesting. And I think that, like, this is something to pay attention to. There's just less money in the capital markets that are going to be wanting to be allocated to these types of investments, only because obviously with interest rates the way they are, it's just a lot of deals are not, they're not penciling like you had mentioned. So I think this is an interesting thing to be paying attention to. So the better the deal, the better the opportunity.
Yeah, 100%. I mean, I work a lot with owner users. So, I work with several that are looking to buy a building for their business use. And, right now it's kind of difficult to make some of the numbers work. So, one of the capital sources that has been, kind of the most beneficial is the SBA. So with SBA financing, the SBA will guarantee up to 40%, I think, of the loan. So it makes it easier for the banks to kind of take on that quote unquote risk. And so, that's where we've been able to get some deals done on the owner user side, is just through going through SBA financing. And although the process is longer and can kind of be a pain to deal with all the paperwork and whatever else, but in reality, it's a great way to be able to get deals done in this market. If they at least occupy 51% of the space, if it's an existing structure, or if it's a structure that's a brand new build, they got to occupy 60%. So again, just
I mean, SBA. I mean, this is a time right now where you have to think creatively. Okay, if you're a broker and you're looking to get deals done, you have to be thinking outside the box, other than just relying on your client to get the financing done by themselves. Like, you can't just rely on it, right? You have to be able to take charge and say, like, no, actually, this is the loan that you should be getting. This is why. This is the interest rate. This is the type of deal that we can actually make. These are the returns. Like, just relying on the buyer to make sense of all these things on their own is why a lot of brokers aren't getting deals done.
100%. Yeah. Creativity becomes a premium in environments where, you don't have the same amount of options you did previously. So flex that creativity muscle. Huh?
Yeah, and look, as simple as seller financing, right? Like understanding how seller financing works, where you're able to get certain deals done with seller financing versus having to rely on bank loans, bank debt, all this extra stuff. Where it's you're going to be able to get deals done what other people can't, right? Where the deals are very close to making sense, or it just barely doesn't make sense, or it's just over the cusp of it not making sense because of bank financing. When you can structure seller financing deals as a win-win for even the next 12 to 24 months, like short-term seller financing debt, it's actually a super lucrative option as an investor and as a broker, where you're able to make deals where other people are just like, I guess it's not going to pencil. Right. And they just throw the deal out. It just doesn't, you have to think creatively. And we're, like you said, if you can learn how to flex the creative muscle, you're going to make money when other people are throwing deals out.
Yeah. Well, I just made 2 seller financing offers this month for different assets that we're looking at for investor clients of mine. So it's definitely becoming more prevalent in the marketplace. And so if sellers are open to it, then, and if they need a little bit of walking through explaining what exactly it means, then obviously that's something that can be a tool in your tool belt to kind of hopefully make sure that you can get some deals done. So,
yeah, I think this is a good opportunity to also be flipping into some Q&A. So
absolutely,
again, depending on where you guys are tuning in from, I'd love for you guys to drop some questions in the comment section down below. Any questions you might have, we're going to be able to rip on for just quite some time. We're going to have to rip for the next at least 10 minutes. Try to, if you want to share some of your opinions on the articles we shared today, your thoughts on the market, your thoughts on interest rates, drop it in the chat box down below.
Absolutely. And if you guys are listening as well, I mean, one of the things we'd love to potentially do on this as well is to analyze some deals that, you guys have currently, or, in the future, if we're just going to be hopping on to the internet and kind of pulling deals down, trying to analyze those as well. So if you guys have any deals that you'd like us to look at, feel free to reach out to us at deals@crenewshour.com. Again, we're very responsive, and we're looking forward to kind of engaging you guys in that way as well.
100%. Yeah, and again, if you have any ideas of what other types of content you'd like to see during these podcast sessions, we're very open. We're going to try to do some of these deal underwriting sessions during these live podcasts, so we can try to underwrite deals, and at least through our lenses, and we can give you a little bit of 2 cents, as well as the deals that you send over to us could just be, if you have a deal, even if it's I wouldn't say if it's just a listing, but even if you have a listing and you're having some tough times selling it, send it over to us, and we'll be able to try to give you some guidance on what you can be doing to try to make it either more marketable and or try to get an offer on it, so that we can try to get the seller possibly down in price if that's what needed. So anyways, we're just here to be able to support you. What else is on your mind, Rafael, these days while we wait for people to drop some comments?
Yeah, no, man, I'm just super thankful. Obviously, it's Thanksgiving's right around the corner. So it's just, kind of a good time to reflect and think about all the great things that have happened to me over the last 4 years that I've been in the business. And, I obviously very appreciative to all the people that have engaged with us over the years. The YouTube channels continue to grow. I've gotten a lot of reach with the books that I have. The podcast is growing very well too. And, you're doing extremely well on your end too. Congratulations. Like I said, last week on the 4,000 subscribers, and it seems like you're getting to a point where you're getting some exponential growth. So looking forward to see where your journey takes you. But again, I think it's just important to kind of understand it's good to sit back and understand that life is short, and we need to be grateful for the things that we have. So.
Yeah, I agree. And look, the social media game is a long game, right? Like I'm going to be in this for another, I keep telling people I'm going to be in the commercial real estate world for the next 30 years, right? Like, I'm committed to this industry for as long as it takes to achieve the vision that I have. And I think the longer vision that you have for certain things, the more that you can achieve. But obviously, for Thanksgiving, it's a good time to say, or reflect on what you do have and give thanks for certain things. I appreciate the audience, appreciate the people tuning in to the journey, listening into our podcast. We appreciate that. And other than that, guys, if you guys have any questions or anything like that, we'd love to be able to bring you more content like this each and every single week. We come to you live each and every single Wednesday at 3 p.m. Eastern Standard Time to review some nationwide articles to try to give you the support and knowledge and our expertise where we can. If anyone else has any questions, we'd love to dive into that.
Yeah. In the meantime, Henry, while we wait, what are some of the cool things that you're working on that you think the audience would gain value from?
Yeah. So 2 things. Number one, I have coming up. Actually, it's coming. Let's see. In December 13th, we have a business planning and setting workshop. It's absolutely free to tune in live. I'll actually put all the details will be on my YouTube channel, my Instagram. So if you don't know, you check that out. It'll be on Facebook, Instagram, everywhere. December 13th, business planning and goal setting, 6:30 p.m. Eastern Standard Time. Love for everyone to tune in when they can. Be able to support you in having the best year yet in 2024. Other than that, I mean, I think for things for people to be focusing on, I think this is an interesting time for people to know that, like, if you want to have a great 2024, you should be prospecting, 90 days ago, because the deals are going to take quite a long time to close. And it's like, if you have not yet doubled down on the amount of time that you're prospecting, my average sales agent is making 400 to 800 calls a day, right? Even today, I'm making, 300-400 calls a day, even on days like this where, we have to try to double down on our lead generation activities. We have to double down on our connecting, double down on all the activities that we know we should be doing on a daily basis, because the money in this year is to increase the things that actually drive the metrics to the bottom line, right? It's like, if hypothetically you made 100 grand in 2023 because you generated hypothetically, one lead a day. If you generated 2 leads a day, you'd probably double your business, right? If you got to work on your lead conversion ratio, if you only, of the 1 lead a day you converted, you closed 4 deals this year to make 100 grand, 25K a piece. If we can help you increase your conversion ratio by 20%, that will also compound the amount of deals you'll do. If you focus on higher price point deals, like we talk about all the time, if your average sales price is $1 million, we can get you to 1.5 million bucks. And we can also teach you how to target these properties off market, where you're not splitting this and co-brokering every deal, but you're actually you're double ending every deal. Now you're double ending a $1.5 million deal instead of doing half commission on $1 million deal. So it's like, these are the types of things to be thinking about into 2024, and things that we're going to be talking about in the training on the 13th.
Absolutely. So we actually have a question that popped in. So Sonic the Hedgehog, they say, who was your mentor for commercial real estate?
I love the name. Love the name. That's funny. It's funny that you actually got that name. So when it comes to my mentor, actually, funny enough, so I got really, really fortunate that my clients are actually my mentors. I mean, these are guys who are incredibly successful, people who own hundreds of millions of dollars worth of real estate. They taught me everything. They taught me everything I know today, and they continue to teach me. So it's like, I've had like the great fortune of learning from people who are actually in the business, and doing the actual thing, right? Those people I analyze deals with my clients, step by step, and they walk me through everything that they're doing. So now it's like I get paid to have an education from my partners.
Isn't that amazing? Yeah,
So
I can't tell you how much I've learned from my clients. Unbelievable. And over time, you develop the relationships with these clients, and I mean, been blessed to build relationships with very sophisticated individuals who are both on the development side and also on the retail side. So operators of 100 plus franchise operations. So very, very sophisticated when it comes to the operational efficiency of business. And so again, you just have these conversations with people. You start getting understanding of what they look for, how they think. And over time, you just, kind of mold yourself to be somewhat similar in that regard. And so, on the commercial real estate side, I've been blessed in that my broker that I joined when I first started took a very strong interest in trying to help me succeed. I've always kind of had that itch as far as getting out there and generating business. I've always just been very competitive individual. So he never had to push me to do any type of, lead generation or getting out there. So, but, outside of that, he's always been there for me to ask any questions I may have. But now at this point, I'm pretty independent. I can kind of do what I need to do. And if I need to do something periodically and I need to have a call with him, and I'll do that. But, after 4 years in the business, I feel pretty comfortable doing pretty much anything.
Love it. Appreciate you guys with the comments. It means a lot to us. Thank you for tuning in. Again, we come to you live each and every single Wednesday, 3 p.m. Eastern Standard Time. For those of you who are tuning in still, we hope you have a wonderful and happy Thanksgiving. Enjoy the time with the family and the loved ones over the next few days. And anything else you want to add to us to the session, Raphael, before we get off?
No, I kind of echo your thoughts. I mean, obviously, we started this, I want to say 6 weeks ago now. So I'm looking forward to seeing what the rest of this year looks like and what 2024 will look like, hoping to become the #1 news source and really commentary source for commercial real estate in the world over time. And so looking forward to help build that with you, my friend.
Likewise, man. Well, and again, we appreciate you guys tuning in. We'll see everybody next week.
See you guys.